Hello, everybody, and welcome to this NZX Retail Investor webinar. My name is Doug Graham. I'm with the Issuer Relationships team at NZX. Today, we will hear from 3 of our listed funds issuers, and we're happy to have them taking the time out to give us updates. Just a reminder of the format on how these things work. We'll hear from each issuer for 15 minutes. That'll be followed by 5 minutes of Q&A. We encourage you to ask questions and feel free to put in as many as you want. The way you do that is there's a text box in the webinar panel of the screen, and we'll see those questions come in and feed them through, and we'll try and get through as many as we can given the time. Anything we don't answer, we'll follow up with and get answers after the session offline. So let's get started. First up, we have we're glad to welcome Paul Harrison from SALT Funds. Paul is a managing director with more than 30 years of experience in finance. He's a director and shareholder at SALT and a portfolio manager of SALT's wholesale funds. So at this point, I'll turn it over to Paul, and in a few minutes, we'll be back with Q&A. So Paul, welcome, and you can take from here.
Thank you very much. I'll just, we've got the screen shared here, so I will kick off with the presentation. So thanks for joining, everybody. It's reasonably topical at the moment in terms of the carbon market. So Carbon Fund, we launched this back in 2018. What is the Carbon Fund? Carbon Fund has the ability to invest in different kinds of carbon units across the world. It's an open-ended unit trust that we've listed on the NZX, and it's been trading pretty happily there for the last couple of years. So currently the fund itself is invested in New Zealand carbon units, and also we have an exposure to some Australian carbon units as well. I'll give you a brief sort of rundown for people unaware of the emissions trading scheme in New Zealand. We launched this back in 2008. We were one of the first countries in the world in terms of a federal system. I think it's the second oldest in the world. It allows the government to reward those companies or those individuals that absorb carbon from the atmosphere, such as the forestry guys, and then the emitters have to purchase units from those the CO2 absorbers that the government has awarded credits to. The standard measure of unit in this sector is really just 1 metric ton of carbon dioxide. There's a whole bunch of different gases that they calculate to the equivalent of, so sometimes you'll see it described as CO2 equivalent. Back in 2000, it had a bit of a bumpy start. That chart there, the bar charts you can see there with the purple bands, they are some of the sort of what you'd probably describe as fictitious units that got created, and they were allowed into the system for a while. The national government in 2011 banned those. 2015, the government signed us up to the Paris Agreement. For those of you that aren't aware of the Paris Agreement, back in 2015, there was a whole bunch of countries there. I think we're up, initially it was about 180, up to almost 200 now, that have committed to reduce their CO2 emissions over the period between 2020 and 2030. New Zealand committed to reducing our CO2 emissions to 30% below what they were back in 2005. And just to give you an idea, what does that look like? New Zealand, our emissions every year was about 80 million tonnes gross. And so you can see the dark line at the very top there, the dotted line there, that's what our gross emissions look like. The 60 odd million tonnes a year, that you can see the line there going across from that. That is our commitment under Paris. So there's about 20 million tonnes a year for the next 10 years that we've committed to reducing our emissions. Now, some of that will be absorbed by forestry, but we've still got quite a way to go to make good on our commitment. So even if we cut it in half, that 200 million tonnes that gets accumulated over that 10 years, you know, when you think we might be paying up to $100 a tonne on that to make good on that commitment, that's $10 billion. So there's a real incentive financially to do this as well, and let alone what's happening in terms of climate change. Also as an aside, that 80 million tonnes a year, 40 million tonnes of that's actually coming from agriculture. So the 20 million tonnes of of reduction a year that people are trying to do. A lot of that's having to come from the non-agricultural side. New Zealand's not alone in having an ETS or a carbon pricing initiative. There's many countries around the world that probably the most well known is the Europeans. The British used to be part of the European ETS, but they've since set their own up. China has had a pilot scheme going. It's expanding rapidly to a number of different industries. California is obviously the biggest, fifth biggest economy in the world. They've got an ETS off the ground as well. I think for me, the really interesting thing with this is that having sort of been on the fringes and looked at different renewable energy ideas over the number of decades now, every time a lot of these initiatives were priced off the oil price, and every time the oil price would go up, everyone wanted to avoid the price of oil and look for alternatives, and then the oil price would collapse and all these renewable projects would go away. Carbon pricing is allowing a lot more certainty for a lot more innovative technologies, and also the pressure on emitters and such to change their ways. So what that's meant is it's actually the governments have found a way to drive change. So this is the pricing in US dollars up to the 30th of June. So the dark blue line's obviously European emissions pricing. So that's almost, it's been as high as roughly about $97 New Zealand. There's the New Zealand scheme there at around $30 US, which is more like $50. I've also included a line at the bottom there of the Beijing ones. So you can see here, this is the NZU price on our market. It's back when we started, it was around $20. It's sitting at $50 at the moment. The Australians have had a little less activity on theirs. They don't have a proper ETS, but we're hoping that they come to the party soon. So what sort of makes this market interesting, I think from our point of view, is the government's introduced a lot more reforms of late to really strengthen this market and make it a lot more resilient. I think the other thing we've seen is we've seen a move away from giving away credits to the auction system. We had the first auction back in March, second one in June. We've got another one coming up next week in September. The Climate Change Commission produced a report recently where they thought the parameters for the auction should be increased in terms of pricing. That's just come out yesterday. So the government has a auction of 4 times a year, excuse me, 4 different auctions where they auction off 4.5 million tonnes. They have another 7 million tonnes in reserve where they can try and keep the price under control. That trigger price where they drop the extra units into the auction has been set at $50. Climate Change wanted it at $70. It will be changed to $70 next year, and then increasing by 12% per annum after that. We've seen quite a bit of pressure offshore as well. You obviously would have seen US redraw in Paris. The Europeans and the Americans, to a certain extent, are talking about bringing in what they call a carbon border adjustment mechanism. It's likely going to force a lot of countries, particularly Australia, I think, to come to the party on this. So there is still a lot of momentum in this in terms of political will. The other interesting thing from our point of view with carbon for investors is that it's not correlated to equity markets that we can see. New Zealand's 0.02. That's the other chart there is 0.05 that someone else has done a global metric on it as well. So you can have an uncorrelated asset in your portfolio that allows you to get exposure to this market of carbon. And that's me. It's obviously an open-ended fund on the NZX, bought and sold on the NZX, or you can apply directly to us on the website at carbonfund.co.nz. And that is me.
All right, thank you, Paul. Appreciate it. We did have a question or two come through. The first one was, how does New Zealand's carbon budget compare with other countries?
So we have it is what they call a cap and trade. So New Zealand is a little unique in the sense that we have forestry in our budget, and we also exclude agriculture, but it's quite similar in many ways. In some ways, a lot of countries are copying what we've done, because we're, as I was mentioning before, we're one of the oldest schemes in the world. So I think effectively our commitments under Paris are less than what others are doing. Germany's, I think, doing like 65% cut to their 2005 emissions. So but we started from a different point.
Okay, appreciate that. The another question is, you talked about the correlation between carbon and equity markets around the world. In terms of risk and comparative to equity markets, are the carbon credits risky in general compared to other equity markets in terms of, I guess, volatility, and in the current climate, how do they look in terms of stability and risk and all that versus relative to equities?
It's a difficult thing to measure in some ways. It's obviously from a historical price point of view, it's been pretty volatile. But I think we find it bounces around according to whatever the government decides to do in that particular time frame. So, when like yesterday, they have put the price up for the cost containment reserve trigger price. So that's created a lot of interest in it. But again, it's in some ways it's an artificial market, so it's driven by policy. And I think people need to bear that in mind. That's why it is also uncorrelated. It is correlated, we think, a little bit with GDP. So we saw when you had the outbreak of COVID, the prices collapsed a little bit, but then it picks up again for industrial production emissions and stuff.
Excellent. So we have time for one more. Let's do it, and then we can move on. But the final question is, and there's another one that we can do offline. But this one's kind of interesting. Will carbon credits continue to rise over time? Pollution looks like it is set to decrease in the future, say 10 years, with EVs and similar initiatives. So how does that impact the credits, the carbon credits?
Yeah, I think that's right. I mean, eventually, we would expect the carbon price to decline as you get on top of emissions and they decline. The point that I think that we're looking at is that 2030 is the agreement that we've got. That's the commitment that we've made. And from our point of view, it looks like New Zealand's a little bit behind the 8 ball in terms of getting to it, what it's committed to. But we've always said that we would wind the fund up once we got to that point. So it's pretty much job done. Either that or we'd look for, that's why we're also looking at other markets. Australia looks a little bit more prospective as well over time, and I think other markets will catch up to us. So from our point of view, it's very much about us looking at the carbon pricing, what the mechanism is doing, how well is that country doing in terms of getting on top of its commitments, and but you should get to hopefully we get to a point where the emissions start to decline and the carbon pricing has done its job.
Yep. Awesome. Well, Paul, thank you very much. Really appreciate the time and effort putting this together and sharing it with us. Any other questions people have, feel free to put them in, and we'll get back to you offline. But thanks again, Paul. Appreciate it.
You're welcome. Thank you.
All right. So now we will move on to Booster, and we have David Beattie from Booster Funds. There's David. How you doing? Just a little background on Booster. David is a principal at Booster. He joined in 2000 as the chief investment officer. He has over 35 years experience in portfolio management and investment research. So I will turn it over now to David, and thanks again for joining us.
Okay, great. Let me just start off by giving you a little bit of background about Booster, which I think is useful just to inform the whole background behind why we launched the Private Land and Property Fund. A lot of people probably don't know too much about Booster, so it's useful also just to give you a few facts and information about our background. So we started in 1998. So 23 years ago now, and we remain a privately owned Kiwi company with 80% of the business owned by New Zealand staff and senior management. We're a fully licensed managed investment scheme provider with around about 100 staff, most of those based here in Wellington. We're now approaching $5 billion of funds under management, and importantly, nearly $3 billion of that is from KiwiSaver. We've been a KiwiSaver provider since inception in 2007, and that's important to know as well. And we were reappointed as one of the 6 New Zealand government-appointed default KiwiSaver providers right through until 2028. We do have a long history of innovative and unique product solutions, so in a sense, the private land and property portfolio is just a continuation of that development. So let's have a look at why the private land and property portfolio. Hang on, I've just lost the screen again. There we go. It actually has its genesis back in 2007 with this remarkable man, Sir Michael Cullen, who sadly lost his battle with cancer last week and passed away. He was an extraordinarily visionary and intelligent man. He's left quite an enormous legacy, not the least of which is being the architect of KiwiSaver and the New Zealand Super Fund. I and a few others went along to the launch of KiwiSaver back in 2007 when Sir Michael spoke at an ASFONS conference in August, and I just extracted a fairly important and useful quote that he included in that speech. More saving helps the strength of the economy generally. Saving builds the wealth of New Zealanders and helps build the pool of assets needed for business investment. Saving will help us own more of our own businesses, and it will produce deeper capital markets that provide the oil for a well-functioning business sector. He made those comments in relation to KiwiSaver, being that pool of fund money to support New Zealand businesses ultimately. So 10 years in the making, really, we established our first wholesale private equity product called Tahi to invest specifically in established, successful, unlisted New Zealand small to medium-sized enterprises. Soon after that, we also established the wholesale version of the private land and property portfolio, which ended up being a natural spin-off from Tahi's initial investment in wineries, where it made a lot of sense to split out the underlying land from the actual operational business itself. And then in 2019, we launched the Retail Private Land and Property Fund and listed that on the NZX with the ticker PLP, which was the first managed fund to list on the NZX under the new listing rules. Let me just talk through some of the vision for the whole fund and its strategy. We did want to honour Sir Michael Cullen's original vision for KiwiSaver, which was to use a portion of KiwiSaver funds to support private New Zealand businesses. We also want to be able to democratise access to the New Zealand horticultural and viticultural land area. It's a massive industry, 6.4 billion horticultural industry. The viticultural industry, $2 billion of exports last year. Also wanted to provide an opportunity to complement and diversify away from traditional property investments, both in the listed and unlisted space, and gain exposure mainly to unlisted horticultural private land in New Zealand, but without having that direct operational exposure. It's very limited direct exposure to the volatility of the underlying commodity and crop prices. We partner with and lease the land to established horticulture, viticulture, and potentially agricultural businesses. We look to secure long-term leases with experienced, well-managed tenants. We don't have any specific sector targets or a total fund size to aim for, and we'll be just looking to broaden the diversification we've currently got, both by crop and location, opportunistically as opportunities come up. I think we also recognise our role in the kaitiaki-tanga of the land. A good example of that, we've got a vineyard in Aratri in Marlborough, which had a small piece of the land which was sort of unproductive and uneconomic to grow continued grapes on. So we've actually planted a strand of manuka trees on that piece of land, just as part of our stewardship responsibilities. And ultimately, we want to provide an attractive income solution in this low interest rate world. So let's just have a quick squiz through the key features of the fund. We're targeting an average long-term return of around 6.5% per annum. That's before tax, but after fees. At the moment, we're aiming to get the distributable income to around about 5% per annum, and the extra 1 to 1.5% should come from long-term average capital appreciation in the value of the underlying land. It's a listed pie, which is taxed 28%, but does have imputation credits. We're now distributing quarterly, and there's a dividend reinvestment plan available. You can buy and sell either directly with Booster or via the NZX with as little as $1,000 only, and you can withdraw your money via us. There are only withdrawal fees that apply if you tick over $50,000, or in fact, you can sell through the NZX where there are no charges other than brokerage. And we have debt facilities at the moment with banks which allow us to gear up to around about 30% on average, which is sort of the steady state debt level. So let's just have a quick look at what makes PLP different. It's a listed managed fund, so it's managed by experienced portfolio managers. It's the only horticultural land-based listed property company currently on the NZX. Importantly, the underlying wholesale portfolio is owned by our KiwiSaver, non-KiwiSaver, super and investment funds, and that generates regular cash flows to support the liquidity of the fund, which means there are also multiple liquidity sources. And the listed price typically of a listed fund is going to trade normally a lot closer to NTA than you would get from other listed property companies. Just have a quick look at the holdings at the moment, which will give you a bit of an idea of the allocation. So if you see, the vineyard properties currently dominate the portfolio. So just around about 50% is in vineyards growing grapes. We've got 21% in kiwi fruit, and our latest acquisition was a hops farm in Waimea, which makes up 8%. You can see also that we've got 18% in cash just sitting around waiting for the next opportunity, and there are plenty out there. Total fund size currently around about 94 million, and gearing's just sitting at 15%, quite conservatively at the moment. We're pretty happy with how it's performed over the last 4 years since inception now, generated a return of about 10% per annum before tax, or 9% after tax. Now, obviously, anything associated with property over the last 4 years has had the value of upside appreciation, so we're no exception to that. The fund has definitely benefited from the significant gains in property values over the last 4 years. But generally speaking, as I said, we're targeting a return of about 6.5%. But it's nice to see that it's got a proven track record now. So just quickly in summary, some of the key things that to highlight: it does provide significant diversification of income for investors and term deposit holders who are able and willing to move up the risk curve, but not too far. We're not looking at a high risk type fund because of the nature of it. It does diversify away from other property sectors, both in the listed and unlisted space. We've now got 4 years of proven yield and return history. I think the liquidity via either directly with us or through the NZX. There are some very significant advantages of it being a listed managed fund. The liquidity is greatly enhanced, the listed price trading a lot closer to the NTA, and we've got an underlying strategic allocation to the property portfolio from all of our booster funds, which will provide regular cash flows. It's pure land ownership, and predominantly with fixed leases with established operators. There's limited direct exposure to the underlying operations or the crop prices themselves. There are regular distributions of the earnings, currently around about 3.5%, but heading towards 5%. And we think it's a unique opportunity to support New Zealand's flourishing horticulture and viticultural industries with as little as $1,000. And ultimately, I think Sir Michael Cullen would be very pleased. So that's me. I'm happy to take some questions.
All right, thanks, David. Appreciate that. I do have a couple of questions, and feel free to send more in as you think of them. But you talked a little bit about the return on land value potentially, and can you talk more about that in terms of, I think you said it had been 1.5% historically, what that type of appreciation looks like and how those returns work for investors?
Yeah, longer term, our target is a total return per annum of about 6.5%, of which around about 1 to 1.5% on average should come from upside appreciation from the value of the underlying property. So around about 5% from the income itself. So historically, over the last 4 years, obviously with a return of 10, we've distributed cash earnings of around about 3 to 3.5%. So we've had appreciation in the value of the land of around 6.5% per annum, reasonably substantial over the last 4 years. But that's, as I say, consistent with just about any other property sector in New Zealand.
Thank you. And then there's a question about the, I guess, liabilities and risks of damage or storms that destroy crops and land, and how do you protect against that? And is it a major concern?
Yeah, we always have to be very mindful, and certainly climate risks and disease impacts on the value of the crops and land are risks in investing in this type of property. The main risk mitigator is diversification, so spread yourself widely throughout the country. We're trying to do that already with our vineyards. We've got exposure sites in Hawke's Bay, Marlborough and Nelson. So that's your main risk mitigator to continue that geographical diversification. The risk obviously is with the tenant itself, who carries the primary risk of crop issue, because they are obligated to pay us the lease cost on the land. So that must continue unless they go into liquidation. So it's the tenant risk, it's the main one. So when buying land, we're making sure that we are very comfortable with the balance sheet of the tenant and that they've got strong cash flows and a balance sheet that can cope with a temporary crop issue.
Thank you. A couple more from the chat that we have time, so we'll get into them. The industry is a heavy user of water. How do you plan for the impact of the water allocations changing in New Zealand?
Yeah, when we buy and look at land, part of our due diligence, water availability is near the top of the list. So yeah, obviously a lot of the crops are water intensive, and making sure that we have got uninterrupted access to water when needed to offset any impacts of drought is certainly a key consideration. Obviously New Zealand has an abundance of water, not to take that for granted, but yes, it's a very key consideration.
Excellent. Well, David, thank you very much. There are a few more questions, but we'll get those to you offline just to keep things moving. But again, appreciate your time and effort putting everything together and sharing that with us. So thank you.
Thank you.
Okay, so whoops. Now we will hear from Donna Mason. Donna is the head of client development at Smartshares, which is a provider of ETFs on NZX. She has extensive experience in KiwiSaver and superannuation products. Donna previously worked at AMP for 10 years in various roles across its advisor delivered and workplace savings products. So Donna can take it from here, and the same thing, we'll get the questions to you as you are winding up. So thanks, Donna.
Thanks so much, Doug. And can I just check that you can see my screen?
Yes.
Thank you so much.
I can, yeah.
Thank you so much, and welcome everybody. Welcome to my living room, and thank you for inviting me into your living room, bedroom, kitchen, bathroom, wherever it is that you're tuning into today. I hope you and your loved ones are well and taking care of each other. As Doug said, I'm the head of client development for Smartshares. I've been with Smartshares for just over a year and a half, and I started just a week before the first lockdown. So it's funny to be back here, and yeah, hopefully we get out of it soon. What I'm going to talk to you about today is a little bit about Smartshares, who we are and what it is that we do. We're going to have a look at our exchange traded funds and talk about why we think exchange traded funds can help you build a solid foundation for your investment portfolio. And then finally, we'll talk about the different ways you can access the Smartshares ETFs. Before I get started, there's some important things to know, and the top two things is that although we've got some extremely clever people in Smartshares, none of us can predict the future. So anything that I talk about today, any returns or performance that we discuss will be focusing on what's happened in the past. And the second thing is none of the information today is to be seen as giving financial advice. So making an investment is a big decision, and if you need some help with that, we strongly recommend that you speak to a financial advisor. So let's look a little bit about Smartshares. So Smartshares was established in 1996 and we're 100% owned by NZX. We're the manager of the Super Life schemes, and there's 4 schemes that I'll talk to you about today. So in the Super Life brand, we've got a KiwiSaver scheme, a superannuation workplace savings scheme, a UK pension transfer scheme, and then a retail investment scheme. And through the Smartshares and Super Life brands, we're really proud to offer financial solutions to over 82,000 New Zealanders. And those 82,000 New Zealanders have accumulated more than $5.4 billion of funds under management. You can see in the diagram below that I've tried to explain our ownership and business structure. So we're 100% owned by the NZX, and then you can see under Smartshares, we've got those 2 different brands there. So on the Smartshares, we've got 35 listed ETFs or exchange traded funds. And then on the Super Life side, you can also access 28 of those ETFs as unlisted funds through Super Life. And we'll go into that a little bit later on. So by now you've heard me say the word ETF a couple of times. Well, I hope that's what you've heard me say. But in reality, what the heck is an ETF? So the way I like to think of an ETF is that it's a basket or a bundle of investments. And I like to think about it as a box of those favorites chocolates. So you've got your favorites box, and in that box there's a little Moro, a little Crunchy, a little Picnic, and so on. But you don't have to go out and buy each of those individual chocolate bars. You're just buying that one package of favorites chocolates. And in that you're getting all of those different flavors. And that's the way I like to think about an ETF. They're a basket or a bundle of investments where you're getting access to all of those underlying exposures, but you're getting that in one ETF. And for those reasons, ETFs are highly diversified. They're traded on an exchange, hence the name Exchange Traded Fund, which means you can buy and sell them just like any other listed share. ETFs track the performance of an index, and each ETF has a slightly different job to do depending on the index that they track. And it's really important that you understand that and know the index that your exchange traded fund is tracking. ETFs are diverse. They can track a whole market, or they might track just a subset of a market. And going back to my analogy about the box of favorites, ETFs are also popular because you can get them at a lower cost. And if you think about that box of favorites chocolates, instead of going and buying a Moro, a Crunchy, a Picnic, a Turkish Delight that no one ever eats, you can just buy that one box of favorites, and you're minimizing your transaction costs and your fees and charges from buying all of those individual stocks because you're buying that one bundle. So why Smartshares ETFs? For a lot of the reasons I've just discussed, first of all, diversification. You can diversify your portfolio through one trade or through a number of ETFs. You're getting exposure to a broad range of underlying holdings. Let's take our NZ Top 10 ETF as an example here. If you invest in that one ETF, you're getting exposure to the 10 holdings, which is the New Zealand Top 10. There's some tax advantages of being invested in an ETF. Our ETFs are all registered PIs, which means that tax is capped at 28%, which is the top PIR tax rate. If you're trading to get a capital gain, that capital gain is part of your income, and income tax is taxed, surprise, and the tax rates can go up to 33% and in some cases 39% for income tax, whereas the advantage of investing in one of the ETF PIs is that your tax is capped at 28%. It's for those reasons we've just discussed, diversification, lower cost, and tax advantages, that we believe that investing in ETFs is a really great way to build a strong foundation or core to your portfolio. At Smartshares, we've got 35 different ETFs, and we're going to look at those in a minute, and you can see the different types of sectors and businesses and variety of themes that they invest in. We've got market cap weighted ETFs that are rebalanced for you. Now, what this means, and we'll use our NZ Top 10 ETF as the example again, is the 10 holdings in that ETF are invested depending on their market cap weighting. As those weightings change, the ETF is rebalanced for you. take that same scenario and think about if you were to go out and buy those same 10 holdings, you would need to do that rebalancing yourself. That incurs different costs and charges again. So investing in the one ETF does have those advantages as well. Smartshares are the only ETFs listed on the NZX, and there's a variety of ways that you can access them, and we'll go into those different ways a little bit later on. So here you go, here's a look at the 35 Smartshares ETFs. You can see that there's a variety of different types, being NZ equity, Australian equity, US equity, global equity, fixed interest. Then we've got some ESG equity, where there's ESG screens on some of those. And then finally, we've got some thematic equity, which is our automation and robotics fund, and our healthcare innovation, which have proven to be very popular. Let's take a bit of a deeper dive into the Smartshares Top 10 ETF and have a look at what it looks like and what it does and what sort of information you'll find about it on our website. So the Top 10 ETF, its code name or ticker is TNZ. It invests in financial products listed on the NZX main board, and it's designed to track the return of the S&P NZX 10 index, and this is a market cap weighted ETF. So as we discussed before, the weightings and the various underlying holdings are rebalanced for you within this ETF. The top couple of rows of detail is the sort of thing you'll find on our website if you go and want to find more information about ETFs. You'll find things like the inception date, which is the date that the ETF started, its index that it tracks, the date that dividends are paid, the asset class that it invests into, the geographic location, and its ticker. The as at date is the date that this information was last updated. You can also see its market price at that date, its NTA, that stands for net tangible assets, and that reflects the value of the underlying assets held by the ETF. You've got the gross dividend yield, which is the before tax, the dividends that were paid at that last June and December dates. You've also got your total fund value, which is the total amount invested in the fund. And I can't quite see what the last one is, but I think it's the fund charges, which is the per annum amount that you will pay to be invested in this ETF. You'll also find information about the top 10 holdings of each ETF. And here you can see the top 10 holdings, which is the total holdings for the Smartshares Top 10 ETF, which is why I chose it to demonstrate today. And you can see the different holdings that it has and the weightings that it has in each one of those holdings. For the reasons we've discussed, we believe that investing in ETFs will build a solid foundation to your investment portfolio. For the reasons discussed, such as diversification, you can diversify your holdings within one ETF or multiple. Again, if you go back to that box of favorites example, you're investing in all of those underlying holdings in that one exposure. It's also a low cost option, and it's something where you can add your extras on top. And let me give you an example. On the top right hand corner, we've got a picture with some circles in it. The big circle says your core, and that's where we think about you creating that solid foundation using ETFs. Your core holdings might contain one or more number of ETFs, and that will give you that strong, diversified, low cost base. It's not to say that's all you have to invest in. Of course, you've got choice of what you can invest in, and there's so many exciting and different opportunities out there. We know people like to take advantage of those, and those are those active holdings around the edge. This diagram is what we call the core satellite approach, where you have your core diversified base, and that gives you a strong platform to go and make some interesting investment choices around the outside and get different exposures to various things. At the bottom there, I've shared this graph as well. This graph is a way to get a really diversified exposure using 5 different Smartshares ETFs. Through these 5 different ETFs, the asset allocation is split between 60% growth and 40% income assets, giving you a balanced, diversified portfolio through just those 5 Smartshares ETFs. There's loads of ways you can access the Smartshares ETFs. You can do it directly through our Smartshares website. You can access them through Smartshares through your financial advisor or broker. You can access them on market via a broker or through online investing platforms such as Sharesies and InvestNow. And the last way that I want to touch on is through the unlisted funds and the super life schemes. So as I said at the start, there's 4 managed schemes under the Superlife brand, and those are the Superlife KiwiSaver scheme, the Superlife Workplace Savings scheme, Superlife UK Pension Transfer scheme, and the Superlife Invest scheme. In those various schemes, there's 28 of those unlisted versions of those ETFs that you can invest in. So that means, for example, in my KiwiSaver scheme, because I'm with Superlife KiwiSaver, I can invest in the US Large Growth Fund if I choose to, or the NZ Top 50 if I want some exposure to that. So again, it's a really great way for investors to be able to access those funds. The Superlife Invest scheme is a retail investment scheme. Again, you can invest in it from very little and get started in some of those exposures. And just like Booster, we were recently appointed one of the 6 government default KiwiSaver providers, which is a status we're very proud of achieving. Smartshares through the Superlife brands also operate one of the largest workplace savings or superannuation master trusts in New Zealand. And then finally, we're extremely proud to support some iwi groups and Pacific nations in supporting them with their retirement savings through our Superlife Invest scheme. So that brings me to the end of excuse me, my presentation. I'd like to thank you so much for listening to me. Hopefully you found it interesting, and if not, at least hopefully it gave you a bit of escape from your lockdown situation today. Thanks, Doug.
Thanks, Donna. That was great. Appreciate the information update. We do have a few questions and have some time, so I'll go through a few of them. There's a couple questions around the, I guess, concept of active versus passive management, and how are the stocks selected within the ETFs, and are they actively managed or chosen based on fundamentals or anything like that? Or maybe you could talk about how the ETFs are constructed and passive versus active.
Certainly, of course I can. And before I start, I've actually invited our Chief Investment Officer, who I'm really hoping is on the line right about now, Stuart Miller, excuse me, to join me in the Q&A section of this presentation. If Stu's not here, I can carry on. No, I just got a text he's not here. So thanks, buddy. Yeah, so there is obviously always a bit of a debate, I guess, or a question around active versus passive management, and what's the best option and how does that all work. So in the Smartshares ETFs, they are passively managed funds, and that means that we track those various index that I said at the start. Each ETF has got a job to do, and that job is to track the index that it follows, and that's what ETFs are there to do, and that's how they work. In the Superlife schemes, we do have a option for active management. We've got a couple of funds that investors can choose from if they like to go down that route. We're not here to say that one is better than the other, that active is better than passive. We think that it's each investor's choice to make their own decisions about what they like to invest in. And going back to that core satellite example, that's exactly what we're trying to explain today, that investors can choose either. It's not one or the other, you can have both, and having that really low cost, diversified base to your portfolio is sometimes a really smart way to go for investors.
Awesome, thank you. And it probably, I guess, a follow-up to that question is how much? I just flipped off my screen here. Where did it go? Yeah, how much do the ETFs change within, or the companies change within the ETF, and how is that done in terms of rebalancing, and is that done by a human in terms of the rebalancing, or is it done through computer programs, and how often, and those types of things?
Yeah, that's a really good question too, and one that I really wish Stuart was here to help me with. So what I can say is that we've got an extremely clever investment management team headed up by our Chief Investment Officer, Stuart Miller, who's not here, but thanks, Stu, if you're listening. And those guys do an incredible job at managing our funds. Each ETF tracks the it tracks the index that it tracks, and the investment management team makes sure that it stays true to that index, and they make decisions around that ETF based on that. So its underlying holdings will change over time. I mentioned earlier that the underlying holdings will be rebalanced based on their market cap weighting. So that's an example of it changing over time.
Nice. I guess away from the portfolio management side, there's a question around taxation, which is kind of interesting. If you were currently living in Australia and paying tax in Australia, but you're going to move back to New Zealand one day, how does that work? You're not a tax advisor, but any thoughts there that you can share would be helpful.
Yeah, I'm definitely not a tax advisor, so I highly recommend that you do go online or get some tax advice. So the question is that they're living in Australia but moving back to New Zealand. I have to say I'm not sure how that works in that situation, but yeah, I'd definitely recommend jumping online and figuring that out. Sorry, I'm sorry I can't help on that one. If there's a particular investor that's got that question, fire me through an email. I'll be more than happy to find the answer out to that for you.
Excellent. So we'll do one more question. There's a few behind it as well. But in terms of resolutions on the companies that they invest, does Smartshares participate in those resolutions or have an analyst that researches different voting, I guess, opinions, or is that just done based on the index?
Yes, we do have a responsible investment policy, and part of that policy looks at the way that we engage with the companies that we invest in. So I would recommend for you to go on our website at smartshares.co.nz. You can read through our policy and look at the way that we engage in voting and engaging with those different companies. So yes, we do have a way that we do that, and if I try to explain it, I'm probably not going to do a very good job, so I'll let you go and have a look at that.
Excellent. Donna, thanks a lot. That was fantastic and really appreciate it. And I think there are more questions, and we'll get those on to you, and we'll get back to the people that had questions that we weren't able to answer. But thanks again for taking the time and walking us through that. Greatly appreciated. So
thanks for having me.
Yeah, no, thanks a lot. That will wrap it up for this version of the webinar, and it's again, any more questions, let us know, but glad there were no kid interruptions or anything going on. Thanks again for everyone for participating, and we will keep you posted on the next one of these, and hope you enjoyed it. So thank you very much.